Good morning. Today is July 6th. It is Wednesday, the last show where I'm flying solo here, and just kind of wanted to start off with across the pond, where Boris Johnson is on the hot seat. Richie Sunak, who operates a similar role to Janet Yellen in the US, he is the Chancellor of the Exchequer in the UK. He says that he can no longer, in good conscience, continue to serve in Johnson's government. Some people think Sunak, who is a former Goldman Sachs banker, is actually looking to succeed Johnson. Sunak's departure was actually a little bit of a surprise. He was in there really to help shore up what was happening in the British economy and what is happening in the British economy, namely dealing with pretty bad inflation and a recession. In concert with Richie Sunak leaving, the health secretary Sajid Javid also resigned. Javid was always kind of on the outs in the Boris Johnson administration, so his departure was not nearly as big of a shock as Sunak's departure. Basically, this is kind of rats fleeing the sinking ship. They're thinking that the writing is a little bit on the wall for the Prime Minister Boris Johnson. He's continuing to face growing pressure to announce tax cuts to help people deal with the inflation, but of course that just creates more inflation. So really people just don't want to be associated with him. They don't want to be associated with the parties that he held during the COVID lockdowns, and they don't want to be associated with the growing economic crisis, whether or not it's his fault. The next general election doesn't actually occur until January 2025. So theoretically, especially after that vote of confidence a couple of weeks ago, Boris Johnson should be safe. Nevertheless, a lot of Tories, conservatives, are looking to force a change to the rules so that they can replace Johnson sooner. And again, Sunak now, by disassociating himself with Boris Johnson, may be putting himself in a position to succeed as prime minister. Again, we're continuing to see the ramifications of higher natural gas prices and just an uncompetitive economy in both Europe and in the UK. The British pound now is down to 118.86, which is a remarkable fall from grace. That used to be, I remember it was 150, 160. Now you're talking to 118. The euro is almost at parity. The euro is at 1.01. Let's just see here, 1.0173. It just took another leg down as the euro continues to sell off. Again, 1% moves in currencies are massive moves. Think about it kind of multiplied by 3x if you're talking about a stock price. So that would be a down 3% move in the euro today, on top of a big move yesterday. And it looks like we may approach parity in euro land relatively soon, which again would be remarkable. This is 20 years low. I mean, we haven't seen levels like this since really the euro first came on. And I remember people talking about it looks like monopoly money, things like that. And what a lot of people have done is that they correlate it with the old Deutschmark to see the strength. And really, this is a remarkable weakness for the euro. And I think that it's going to continue to weaken because I think that the natural gas situation there is just untenable. You have an economy that is very reliant on industrial output. They don't have a very strong tech sector. So they need natural gas as a feedstock for a lot of their products that they produce. Problem is natural gas prices, and we'll talk about this in the macro presentation next Tuesday. Natural gas prices in Europe are just through the roof and don't seem like they'll be coming down anytime soon, as long as Russia continues to leverage its power by not providing natural gas through the pipelines. Here in the United States, we continue to experience a little bit of a commodity crash. So after the bubble that happened really in April and May, we started to reverse that again in June, and we're continuing to make lower highs in oil. And finally, oil really broke significantly yesterday. Oil, in fact, was trying to gain about $3 yesterday when we spoke in the morning, but then throughout the day, it lost $10 per barrel. So there was a $13 swing in the price of oil. Overall, the price of oil was down 8%. both here in the US and on the international side. Natural gas was down 6%. Copper fell 5% and is now down 26% from early June. So basically, everything that we've been talking about for the last week is really coming to fruition in commodity land now as well, as we shift from stagflation to full out recession. And I think that's the call for Q3 as we move ahead. And we also are waiting more information on jobless claims and job openings. We do get some job openings data at 10 a.m. this morning. That'll come in the JOLTS number. Now that's a little bit of a delayed number because that comes out in, that's the May read of job openings in the United States. Job openings have remained relatively robust, although I do expect those to start to come down. We're seeing the ripple effects now. We're starting to see the inflation squeeze taper off. Then you're starting to see that taper through into demand as consumers get squeezed a little bit more. And as that demand falls, what we will see is companies that have to employ fewer people. And when you employ fewer people, there are fewer job openings and people actually end up getting laid off, which then causes more demand destruction. And so we're kind of on the front end of that wave. We've seen the initial demand fall, but we haven't seen the layoffs yet. But I do expect that those will likely come. Just as we have too much inventory, we probably have too many employees in certain pockets of the economy. We've seen big declines in software job openings, and we've seen big declines in marketing job openings. And I would expect that to ripple throughout the economy over the next few months. It kind of seems pointless bringing this up now, but I remember back in March, we were talking about a yield curve inversion where the 10-year yields less than the 2-year on the Treasury. And we've inverted again today. So I think that we are in recession. So it's kind of pointless that it signals recession, but that's just something to watch as the yield curve has inverted. Later today, we get ISM services out at 10 a.m. We have JOLTS job openings for May out at 10 a.m. And then we have the FOMC meeting minutes out at 2 p.m., where we'll probably be looking for another 75 basis point increase in interest rates. At this point, with the market pricing in so many interest rate hikes already, I wouldn't be surprised to see that actually read dovishly, which means everyone's already expecting 75 basis points, and therefore to come out with 75 basis points and maybe you'll do 50 in future meetings, that might actually be perceived as dovish, which could have some relief for the market and could allow the euro to rally versus the dollar from this oversold level. But we'll see what happens. Again, I think the fundamental trends are in place, but you're going to see some noise up and down as we get through earnings season over the next few weeks. With that, I'll leave it there. Short one today. We'll see you tomorrow, and Tom and Andrew should be back. Bye.